Hi everybody. Today we're going to be working with Financial Accounting Chapter 3, Measuring Business Income, and we're going to be focusing on Objectives 3 and 4. First, Objective 3, we're going to be learning about the 4 primary situations that require adjusting entries and illustrate typical types of adjusting entries. So, an adjusting entry is just basically a way that we apply accrual accounting to transactions that span more than one accounting period. So that can be more than 1 month, more than 1 quarter, or more than 1 year. There are 4 typical situations that require adjusting entries. And when we do an adjusting entry, each adjustment will affect 1 balance sheet account and 1 income statement account. We should also note here that adjusting entries never affect the cash account. So keep that in mind. They never affect the cash account. So we refer to adjusting entries as either accruals or deferrals. So let's learn what the basic definition of an accrual is. An accrual is basically when there's a recognition of a revenue earned or an expense incurred that has arisen in the business but not yet been recorded. So basically, in an accrual situation, no cash has been received or paid at this point in time. Meaning prior to the actual adjusting entry, no cash was received and/or no cash was paid. This differs from a deferral, which is the postponement of the recognition of an expense already paid or a revenue already received. So in this situation, cash has already been paid or cash has already been received. And if you look on page 144, you'll see an example of what I'm discussing. On page 144, you'll see the 4 types of adjusting entries that we'll be referring to. And you'll see a little table that shows both the asset and liability accounts and the expense and revenue boxes, reflecting whether there's an adjusting entry that's an accrual or an adjusting entry that's a deferral. So this diagram or figure is basically what you would see on page 144. And as you can see, the balance sheet accounts are reflected at the top of this grid, and the income statements accounts are reflected on the left side of the grid. From this, you can also see which box on the grid refers to a deferral, and whether it's a deferral of an expense or a revenue, and which box on the grid relates to an accrual and an accrual of a revenue or an accrual of an expense. So in essence, we have 4 different types of adjusting entries that we would do. The first ones, the type 1s, are costs that have been recorded that must be allocated between 2 or more accounting periods. The second, this is where we have an expense that has been incurred but has not yet been recorded. This would be considered an accrued expense. Type 3, these would be revenues that have been recorded but must be allocated between 2 or more accounting periods. This would be a deferred revenue. And fourth, we have revenues that have been earned but not yet recorded, and this would be an accrual. The question or the tip that I can give to you here in terms of trying to decide whether something is an accrual or a deferral is ask yourself whether cash has been paid or cash has been received yet. With regard to accruals, no cash has been paid yet or received yet. Deferrals, cash has already been paid or cash has already been received. We are delaying something. So you can see from the chart that deferrals are situations where boxes 1 and 3 are affected, and accruals are boxes where 2 and 4 are affected. Now, let's spend a little time discussing each box and what types of situations take place in each box. So let's look at the first box here. Deferrals in boxes 1 and 3. Let's first focus on box 1 with deferred expenses. So, a deferred expense is when we allocate recorded costs among 2 or more accounting periods. So again, we're going to ask ourselves, has cash been paid, or if cash has been paid? And in this case, cash has already been paid. So then what we're going to look to do is adjust and recognize how much of the item that has already been paid have we used up. So examples of typical types of deferred expenses would be prepaid insurance or supplies. We've already paid for those items, and now in each accounting period, we're going to show how much of that item has been used up. If the cash was already received, then the adjustment would be to recognize the revenue. So this is when we're going to allocate revenues among 2 or more accounting periods. When the cash is received in advance, such as when we have an unearned revenues, we're going to do the adjusting entry where the liability gets debited and the revenue actually gets credited. So the balance sheet account that gets affected in these adjustments for deferred revenues are the unearned liability, and then the income statement account would be the revenue account, which would be credited. Now let's look at the accruals. The accruals are boxes 2 and 4. Accrued expenses are basically expenses that have been incurred but not yet paid for. So no cash has changed hands yet. So we're going to record the unrecorded expense and thereby doing an adjusting entry to record the expense and debit, record the expense with a debit and record a liability as a credit. Typical types of transactions that are accrued expenses would be wages payable or interest on loans payable or utilities payable. These we've talked about before, where you get that utility bill in, okay, you've already incurred that expense, but you've not yet paid for it because the bill is maybe not due until the next month. So you get the bill in, you've incurred, you've already used up some of those phone privileges or you used your utilities, but you're not paying for it until the next month. But you've still got to recognize that you've incurred that expense. So you recognize the expense and you recognize that you have a liability to pay that utility company. An accrued revenue is when you have revenues that have been earned but not yet recorded. These would be such situations as where you've earned a fee but you've not yet billed or collected from the customer. So the adjusting entry would look like this. The asset account will get debited and a revenue account will get credited. So for instance, let's say we had fees that we had earned. We would debit our accounts receivable and credit our revenue. Or if we had interest that we had earned, say we have a bank account and we earned interest on that bank account, we would recognize that by debiting an account, interest receivable and crediting the interest income. Now let's go through the adjusting entries that would take place. So common examples in type 1, allocating deferred expenses. Common examples would be prepaid insurance to insurance expense and supplies to supplies expense. So these would be examples of where we're saying we have an asset that has yet to be allocated to an expense, and now we're going to do the adjusting entry to reflect that. So our example here is that we recorded costs that are allocated between 2 or more accounting periods. So our adjusting entry would be to debit our expense account and we would credit or reduce the asset account. The amounts would have to be equal, as we know. Another type of adjusting entry for type 1's allocating deferred expenses would be the adjusting entry for depreciation of property, plant, and equipment, which we will spend more time learning about in later chapters. But for now, we're going to debit the depreciation expense, and then we're going to credit what we call a contra asset account. The contra asset account is accumulated depreciation. That accumulated depreciation would be matched with a related asset account. Henceforth, it's called a contra asset account because it has a normal balance that is opposite the balance that it is associated with. So this is a little bit more of a complicated type of deferral because we have that contra asset account that's thrown in there. So let's look at what this is going to look like from a journal entry perspective. So when we have depreciation of property, plant, and equipment, we're going to debit the depreciation expense to recognize the expense, and then we're going to credit the accumulated depreciation of the art equipment in this case. And so we're going to debit them for the equal amounts. This accumulated depreciation account is going to be associated with that art equipment that is an asset. So this contra asset account, this contra, meaning the opposite, will have an opposite normal side balance to the art equipment, which would have a normal balance on the debit side. Let me see if I can explain this a little bit further. So when a company buys a long-term asset, a building, trucks, computer equipment, in this case art equipment, that asset is going to be used over a long period of time for that business. It is, in effect, a way of prepaying for the usefulness of that asset for as long as the asset is going to benefit the company. So the long-term asset is considered, if you will, a deferred expense, meaning the company has acquired it, but it hasn't all been used up yet. And therefore, we can't expense that whole long-term asset. What we're going to do instead is we're going to expense or show that that asset is being used up over the periods of time in which it is being used to generate revenues for that business. So we're going to allocate a portion of its usefulness in each accounting period to show that it is being used up. Because a long-term asset is essentially a deferred expense, the accountant must allocate the cost of the asset over its estimated useful life. The amount allocated to any one accounting period is called the depreciation or depreciation expense. Depreciation, like other expenses, is incurred in each accounting period to help generate revenue for the business. So those assets are helping to generate revenue for that business. So therefore, we have to show in that accounting period how much of that asset is being used up or worn down to make sure that we're matching our revenues and expenses. So let's go through some specific definitions relating to the depreciation and the depreciation expense. So depreciation expense, like other expenses, is incurred in each accounting period to help show how the long-term asset is being used up during the accounting period in which it helped to generate revenues for that business. It's often impossible to determine exactly how long an asset will last or how much is used up in one accounting period. Therefore, managers, businesses make estimates about depreciation. They use accounting assumptions that are applied consistently to determine the amounts of depreciation to allocate to each accounting period. They use these assumptions to calculate the amount of depreciation and debit that depreciation expense for that asset, and then credit the related accumulated depreciation and offset that to the value of the long-term asset. Accountants do not decrease the value of the long-term asset on the books of the business. That is because they want to show how much the asset was at cost. Lastly, we have our type 4 adjustments. These are our accrued revenues. And what we're doing is adjusting for unrecorded accrued revenues. In this particular case, we have revenues for which a service has been performed or goods have been delivered, but yet we have not necessarily recorded a transaction, so we need to make sure we record that transaction so we properly reflect the amount of revenues that we have earned during that accounting period. So now, just take a few minutes to answer the question, what do plant and equipment, office supplies, and prepaid insurance all have in common? And you can answer this in your Google questions that will be sent to you. And then secondly, you will answer, why do businesses perform adjusting entries? And then you will also answer these questions here relating to identifying what types of adjusting entries each one of the transactions is on the left-hand side. Now let's move on to Objective 4, which is to prepare financial statements from the adjusted trial balance. Now that we've done the adjusting entries, we can prepare that adjusted trial balance and then prepare our financial statements. So we use the adjusted trial balance because it's a listing of all the accounts and their balances after all adjustments have been made. And again, just like with the original trial balance, all debits should equal credits after all of the adjustments are made. The adjusted trial balance is prepared obviously after the adjusting entries have been recorded and posted, both recorded and posted. So the journal entry is recorded and then the transactions in the journal are posted to the ledger. The adjusted trial balance is a listing of all the accounts and their newly adjusted balances. And then lastly, the adjusted trial balance should have equal debits and credits. And then we use them to prepare the financial statements. So why is the income statement the first statement that we prepare from the adjusted trial balance? What is important or what's significant from the income statement that we need to prepare, to make sure that we prepare the income statement first from the adjusted trial balance? And then here is a little snapshot of the relationship of the adjusted trial balance to the income statement, balance sheet, and statement of retained earnings. And, oops, my bad. Sorry. The order of the statement preparation is, if you would, put that down. The order of the statement preparation is what is first, what is second, and identify what is third. And then lastly, in this particular problem, you're going to look at the trial balance for information for Carroll Corporation, and it contains the following accounts and balances: common stock 180, retained earnings 120, dividends 100, service revenue 1100, rent expense 300, wages expense 400, telephone expense 100, income taxes 50. So what you need to do is compute the net income and prepare a statement of retained earnings for the month of December. Now, in computing the income, remember, you can reflect back to how this income statement is prepared here. Make sure that when you're preparing this income statement or when you're calculating the net income, that you're using only accounts that would be reflected on the income statement. Please make sure you do not take into consideration accounts that are not part of the income statement to calculate your net income. So you must calculate your net income and then from the net income prepare the statement of retained earnings and make sure you're using the appropriate accounts for the statement of retained earnings. Okay, thank you, and that will conclude our notes for Objectives 3 and 4.